Okay, yeah, trailing stop. We talk about the trailing stop. I think we've actually explained this, and I also told you about the trading platforms that we have, and I said we have varieties of trading platforms, but the one we'll be making use of is the MetaTrader and the Trading View. So, and I said that the Trading View, if you don't know how to use the Trading View, a link has already been sent. You can just check the group where you are added to check for the link on how to use the MetaTrader to watch that video. And also there is a link there also, or you check our YouTube on how to use the Trading View platform. The Trading View is where we analyze our trades. So we'll be using the MetaTrader and the Trading View application. So these are various platforms that we have. Their logo: Trading View, MetaTrader, Ninja, DXTrade, CTrader, TradeStation. Alright. So today now we want to talk about the different types of analysis that we have in trading, not just forex market alone, in trading generally. So first we have technical analysis. These are approach that we use to take decision in the market. And the first approach is the technical analysis. The technical analysis is the usage of technical tools to speculate what the market will do based on previous price movement. It's just as if we already have a data, and based on the data we have, we look through the data and check what has happened before. So with what has happened before, we now use it to speculate or forecast what is going to happen next. You know, just like let's use this kind of illustration for those who play sports betting. So if they want to carry a particular team to win, they want to check the previous performance of that team. How have they been performing? Are they at their peak period or they are struggling? So if they find out that probably maybe 5 matches ago, 10 matches ago, the team has not been so consistent, so you know you would not want to bet your money on that kind of team. But if you see that okay, this team has been in form, you will want to bet your money on them. So what they have just done there is to use data. They use data, previous data, to forecast what they are expecting to happen next. So technical analysis is not different from that as well. We use what has happened previously. We have different things that we put together to check what has happened previously, and then use that to speculate what we expect the market to do next. A series of technical tools that we have are indicators, candlestick, trend line, support and resistance, Fibonacci, different concepts like that. And it is under technical analysis you will see people mentioning strategy. Strategy means approach, tactics that they use to trade. So we have different technical strategies. We have the SMC, ICT, BTMM, we have price actions. There are a lot. Institutional order flow. Not that the way a particular trader trades, another person is using another strategy does not say that maybe one person is wrong and the other person is right. One strategy is not superior to another. Okay? All strategy works. All strategy works. Because most question that newbie trader want to ask is that what strategy do you use? What strategy do you use? Whereas the main thing is actually not strategy. There are other things that are involved, which are the trade management analysis, the emotional and psychological analysis. The technical only helps you to pick a point where you want to take your trade. It helps you to identify trends in the market. It helps you to know what to expect in the market. That is technical analysis. Okay, so we have different tools, and we are going to be showing you how we trade and how we want our students to trade, which is one of the simplest and easiest approach to the market. So that is technical analysis. And the next approach that we have in trading is fundamental analysis. Fundamental analysis is the kind of approach that makes use of economic data to take decision in the market. Economic data means information that are likely to affect the state of the economy, which alternatively is going to affect the country currencies, because there are some outcomes that happen which usually affect the currency, the strength of a currency. There are some data that will come out and strengthen a particular country currency, and there are some is going to weaken the country currency. So these are under fundamental analysis. And one particular economic data that we so much care about are inflation rates. The rate at which consumers are buying goods and services. If the price is too high, it means there is inflation in the country. It means that prices of things are going up. That tells us that the economy is not doing fine, because inflation is high. Just as what we are experiencing in Nigeria, every day things are going up. If you buy a particular product today, you go there the next morning, they tell you that the price is no longer the same. So that is inflation rate. This in turn will affect the strength of Naira. That is fundamental based analysis. Another thing is geopolitical wars. If there is crisis in a country, investors will pull out their investment in that country. And when investors are pulling out their investment, that means that country economies will be depreciating in value, because there's something we call GDP, gross domestic product. People are just pulling out their investment. It means the GDP data will be reducing, which is going to affect the country currencies. So we also have different fundamentals that affect the market, which we are still going to show you how to use them. And thirdly, we have sentimental analysis. Sentimental analysis is another type of approach that is now based on what most traders want to do. There's a platform for that. You want to check what most traders want to do, if they are ready to take risk or they are not ready to take risk. If traders are ready to take risk on a particular asset or currencies, you also want to join them, because most of them want to risk on that. Let's say maybe example like gold. You find out that a lot of traders want to buy gold. So based on sentimental analysis, you want to be sentimental in the sense that you want to join the majority of traders that want to buy gold. That is sentimental analysis. And also, if there are just few people that want to buy gold and there are large people that want to sell, you want to join the majority. That is sentimental. You want to be sentimental. This way you don't actually have a proper technical analysis approach. You are not making use of fundamental analysis. You just want to go where the people are going. You want to go where the people are going. I think in economics they call it bandwagon effect. If most people are buying iPhone, you too just want to join them to buy iPhone, because that is what the majority are using. That is sentimental analysis. So it is solely based on traders' mood, if traders are willing to take risk or not. If they are not willing to take risk, then you are not willing to take any risk. If they are willing to take risk, then you also want to join them and take risk. So that is sentimental. So let me recap. So in case technical analysis, I said it is the usage of technical tools to speculate or forecast what the market will do based on previous price movement, based on how price has reacted before, based on what price has done previously. Then you want to use that to forecast what price is going to do next. And I said we have series of technical analytical tools that you can use, which are indicators, chart patterns, candlestick, trend line, etc., etc. There are many technical tools that we can use, and I said this is where trader talks about strategy. We have the ICT, which is the inner circle trader, SMC, the smart money concept, BTMM, which is the beat the market maker, institutional order flow. So these are different strategies traders use technically to approach the market. We also have the pure price action. Okay. And fundamental, I said we make use of economic data, news. You want to be familiar with news. You want to know what is going on in a particular country. If you are trading the US dollar, you want to make sure you are following back to back with what is happening in the US. You want to know if the president has said something that is likely to affect the currencies, if there is any political wars, if there is inflation rate. You want to know about what is going on in their country as to forecast how that news may likely affect their currency. That is fundamental analysis. Sentimental is when you do not make use of technical neither fundamental analysis. You only want to follow through where majority of traders are going. If majority want to sell, you also want to sell. If majority want to buy, you also want to buy. That is sentimental analysis. So now we have trade management analysis. Trade management analysis, it is what you do after you have placed a trade. How you manage a trade. How you manage a trade. That is, which involves your setting of stop loss, setting of your take profit, usage of your trailing stop, which we expect. So these are under trade management. When you buy or you sell, you don't just leave that trade like that. You also want to keep checking as to what is going on with that trade. So every other thing that you want to be doing next is under trade management. You want to manage that trade, because there are times whereby you're already running in profit and then you lose all that profit and still end that trade in loss. It means one has a poor trade management techniques. So we will also be teaching you this. And lastly, we have emotional and psychological analysis. Emotion, this is factored into behaviors of individuals, how you react, your emotion. And one way that you can tame your emotion is by risking what you can afford to lose. This statement is always stressed in trading. We have a lot of people that have said it over that risk what you can afford to lose. That way you will not be too emotionally attached to your trade. Now, emotion cannot be fully eliminated when it comes to trading, but you can minimize them. With as little as $10 that you put at risk, your mind will still be there. But because it is not so much amount of money, if that trade should go otherwise, you will not be too emotionally attached compared to when you are risking more than that amount. That is when you have to be looking at your chart all the time. You will have to be following through with every tick of movement in the market, and that way is going to mess your emotion and your psychology. Your psychology now is your mindset. Your mindset, how you think, what is your thinking towards trading. Do you also have the notion that trading is gambling? Do you also have the notion that trading is where you can just come in under 2 weeks and you can rack in millions into your account? So you have to be psychologically balanced. Your mindset has to be clear. You need to see trading as business. You need to see trading as business, because trading the financial market is also a career path. It's also a career path. So we also want to treat it as one. You don't just want to say happy because of flashing things that we are seeing on social media and we just think that is how it works. Not until when you now get into it and you see that this is not how this thing is. That is why most people back out, because the kind of mindset they bring into the market is not what they are seeing. So they just have to back out that no, this is for me, this is beyond me. You already know that trading carries risk. So anyone that wants to come into trading should be prepared for losses. So how we can now prevent ourselves from having a bigger loss is through trade management. All of these things are interwoven. They work hand in hand. And also we need to caution ourselves in terms of hope and greed. Greed is one of the killer in trading. Greed. If you are too greedy, it's going to show in your trade. You already have a trade that is running in profit, and the trade has already given you what you think is actually okay, but you refuse not to close that trade and still feel like the market is just still going to keep going in your direction forever and ever, which it doesn't work like that. So greed, and at the end of the day you eventually lose that account. Hope is when you are in a losing trade and you already see that the market is far gone and you ought to close that trade, and then you eventually hoping that the market is going to reverse back, hoping that okay, it's going to come back, whereas you should have just short your losses. So these are things that are under analysis when it comes to trading, and we'll be walking you through all these 5 steps. So we are going to be starting first with technical analysis, the usage of technical tools, and we'll be taking it one after the other because we have series of tools that we use to trade. So we are going to be treating one after the other. We are not jumping one and leave another. We will take it step by step. All right? Okay. Or do you have any question before we proceed?
I understand you.
All
Go
right.
ahead.
Okay. Now we have types of charts. This is under technical now. Types of charts. How you see your chart screen. There are 3 major types. We have the line chart, bar chart, and the candlestick chart. The line chart shows you lines of how market price is moving, either is going up or is coming down. But traders cannot really get much information on this type of charts to take trading decision, because what you only have is line. You are only seeing just the way the market is going up and down. There's no good thing to actually tells you that this is when to take opportunity in the market, this is when to get in the market, this is when to get out in the market. That is line charts. And we also have the bar charts. The bar chart is like an holding chart that traders use in the early stage of trading. The bar chart, it looks like bars. In a couple of minutes I will be showing you how the bar chart looks like. So with this chart, traders can use they can see what is actually going on. They can see the interaction between buyers and sellers in the market. They can see who are present in the market. Is it the buyers? Is it the sellers? As to know what decision to take in the market. And lastly, we have the candlestick chart. The candlestick chart is like a full form body of the bar chart. A full form body of the bar chart. It is the most common chart every traders use in this modern day. With this, trader can get enough information as to what is going on in the market. They can know when to get in and when to get out, because the candlestick speaks to us. It is an information that we get from the market when there are buyers in the market, when there are sellers in the market, when the market is in a range, that is, there are the numbers of buyers and the numbers of sellers is at equilibrium, they are equal. So the candlestick help us to understand all of this information. So which is what we are going to be talking about. So let me just quickly show you these three types of charts so you can see the difference between them all. So this one here, this is the candlestick charts. This is the candlestick charts. The candlestick charts is a representation of price movements. Is the representation of price movement. This is the line chart. Now you can see that the line charts, we only have just the lines going up and coming down. But with this, we cannot really tell what is exactly going on in the market. We have less information. We can't really tell what is going on in the market. This is the bar charts. Now I told you that the bar chart is what the olden days traders make use of. This also lets us identify what is going on between buyers and sellers. But modern day traders don't make use of this. We now use the candlestick. I told you that the candlestick is a full form body of the bar chart. If you look at this bar chart, it's just like a sketchy diagram, but the candlesticks is a full body. You can see that there are no difference to it. The candlestick just have a full body. So the candlestick help us to know what is going on in the market. They are sending message to us. They are sending message to us as to what to prepare ourselves for. We also have different types of charts. The chart is not limited to just these three. We have this holo candle. We have this holo candle. It's also like the candlesticks. We have the volume candle. So the Trading View app, we have the paid version and the free version. The one I'm using here now is the free version, which we'll be unable to access some tools. So there are some tools here which this is another tools. This is the area charts. The area chart, we have the line and then we have a shaded button. So here we just see how price is going up. You should be familiar with this if we watch more of news. If you watch more of news, when they are talking about economic data, stuff like that, they used to bring up this kind of charts. But as a trader, the one we make use of is the candlestick charts. All right, do you get that? Okay, so now candlestick, we want to look at candlestick. So we'll start looking at candlestick. That is the first thing, that's the first technical tools we'll be looking at. What are candlesticks and how do we interpret them? Sorry, please, your background is noisy. Okay. A candlestick shows us a price bar with an opening price, a closing price, a high price for that time period, and a low price for the same time period. The body of the candlestick shows the open and close prices, while the shadows on top and bottom of the body show the high and low price for that time period. I'm going to explain this for you. I'm going to break it down so you understand this properly. The candles usually have a body and a wick. The wick can also be called a shadow at both ends. Though there are some candlesticks, they will not have the wick or the shadow. The body represents the distance between the open price and the closing price for a given period. The wicks or shadow shows the upper and lower price ranges. Any of these individual parts may be missing from a given candle. That's why I say some candlesticks may not have the wick. So now this is a picture of how a typical candlesticks look like. The one in green color here is the bullish candle, and the one in red is the bearish candle. You know, I said there are two things. There are two players in the market, or let me say there are just two things you can do in the market. You either buy or you sell. If you are buying, it means you are bullish. Remember that we said bullish is when the market is going up and bearish is when the market is going down. So when the market is going up, the one thing that used to tell us that there are buyers in the market are bullish candlestick. And for us to know that the market is going down, we have bearish candlestick. So for a typical bullish candle and a bearish candle, it needs to have these four components. In fact, it is five components, which are the high, close, open, low, and body. The high is the highest point that candlestick ever gets to, the highest price the candlestick ever gets to. The low is the lowest point the candlestick ever gets to. And this high and low also comes with price. It helps us to know that a particular candlestick has actually pushed to a particular extent, either high or low. And open is where a candlestick begins, where it opens, where it starts, when transaction starts. You know, when you, let's say you open your shop in the morning, and let's say the first product that you sell from your store is 2,000 naira, so that is the open. Or another illustration is when you are taking a stock to know the opening price that you are opening with, maybe for that week or for the day or for the month. You are going to make calculation of what you have in store, what you have in banks, to know, okay, this is what I start with. So the same thing, the open of a candlestick is where a transaction begins. The close is when the transaction ends. The high is the highest peak of negotiation between buyers and sellers, and low is the lowest point of negotiation between buyers and sellers. I'm going to still explain this properly to you on the chart. So open, close, high, low, and then body. Body are the shaded parts that you are seeing, the green and the red. The shaded part, you can see how long it is. That is the body size of the candlestick. And the body size is determined by the range between the open and the close. If the range between the open and the close is very, very big, then that means the body size of that candlestick will be bigger. If the open and the close range is very small, it means that the body size of that candle will be very small. Okay, so for a bullish candlestick opens at the bottom, as you can see right on my screen. It opens from the bottom. Why does a bullish candlestick open from the bottom? It is because it is going up. this journey is up. So if you are going up, you want to start at the bottom. Consider yourself as a person who wants to climb a. You don't just jump to the very top of that ladder. If you want to get to the top of that ladder, you have to start from where? From the bottom. So for a bullish candle, it opens at the bottom and then closes at the top. It has its highs at the top and low at the bottom. For bearish candlestick opens at the top. Why does this open at the top? Because it is expected to bring the market down. The same way you have climbed a ladder to the top, probably you are fixing something on your roof. If you want to come down, you just can't jump from your roof to the floor. You still want to use that ladder, then now come from the top to the down towards the bottom. So that is why a bearish candlestick opens from the top and closes at the bottom. The only similarities between a bullish candlestick and a bearish candlestick is that they both have their highs and low at the same point. The high is at the top and the low is at the bottom. What differentiates them is their open and close. The bullish candlestick opens at the bottom, the bearish open at the top. The bullish closes at the top, whereas the bearish candlestick closes at the bottom. So this is the anatomy. When we say anatomy, it means the inside, what comprises a candlestick. So quickly, let me just show you this explanation on the live chart. Let's go to the chart. All right, now if you look at this, let's just pick, okay, let's pick this candlestick. On this my own chart here, the green candlestick represents the bullish and the red represents bearish. You can actually customize it to your own preference. Whatsoever color that you may like, you may customize it to your own preference. Okay, so now we have this candlestick. Now you can see that this is a bullish candlestick. Now the wicks, this is the wicks, or you can also call it shadow, wick or shadow. This one has a long lower wicks and a smaller one at the top. And look at the body size. The body size is not so big. It means that the difference between the open and the close is not so big. And if you look at this too, is a bigger candlestick. It means that the difference, the range between the open and the close is very, very big. So that determines the body size of that candlestick. So for this bigger candlestick, if you want to label it now, because it is a bullish candlestick, this is the open, this point here is the close, this point right here is the high, and this one here is the low. This is the low of that candlestick. Bullish, and then we have bearish. Bearish opens from the top. Bearish opens from the top. So this one starts here. This is the open. This is the close. The low, you are going to use the wick. The lowest point that wick gets to, that is the low. This is the high. Okay. So now, why do candlesticks have wicks? Candlesticks have wicks to let us know that there was a time that the market pushed up to that extent. So to show you that properly, let us use the 1 minute chart. So you are going to see how the candlestick open and closes. We have different time, and each time, that is the candlestick will form for that time frame. As we are on the 1 minute chart, it means that every candlestick here will form for 1 minute. If we should switch our charts to the 15 minutes, each candlestick here we formed for 15 minutes. So a 15-minute candle, you are going to have 1 minute, 15 candles of 1 minute inside of a 15-minute candle. Same way, if you should switch to the 1 hour chart, each candlestick formed for 1 hour, it is still the same chart, but because we are switching different time frames, the candlestick will change. We are still going to talk about how to use this time frame to pick a trade, because they have their own usefulness as well. So let's go back to the 15 minutes. Just want to show you how a candlestick opens and closes. So this current candlestick is going to close in the next 40 seconds. So let's look at it, and then you are going to see how candlestick open and how it creates wicks. So the same way it's happening here, that's the same way it happens in other time frames, because this one will be more faster and it won't let us waste much of our time. That is why I'm showing you the 1 minute chart. So now you can see as the candle is pushing up, if it should come down, it's going to leave a trace, you can see, and it's going to leave a wicks. That is to show that price gets to that point. So when it drops down, it's going to leave a trail, and that trail is the wick, or you call it the shadow. So you can see this one close here, and then another candlestick starts. So transaction is going on. The thread is showing that sellers are in this market. Now push up, buyers are in the market again. So it tells us the transaction that is going on between the buyers and seller. Once the 1 minute is completed, we are going to know who are more in the market. Is it the sellers or the buyers? Now it's looking like the sellers are more in the market. That is why we are seeing a bigger bearish candle. Market push up, leave a trail, the buyer steps in. So it helps us to know the transaction that is happening in the market. So in less than 10 seconds now, this candlestick is going to close, and then we'll know who are more in the market. So now the candlestick close, we have a bigger body size of a bearish candlestick, which tells us that there are more sellers in the markets. But this is not how, we don't just base our speculation on candlestick alone. You know, I said previously that we have different technical tools that we use. So we combine all of this together before we actually pick a trading decision. I just use this to show you how a candlestick is formed and how it closes. So we are going to be talking about different candlesticks and their meaning. Different candlesticks and their meaning. So there are actually majority of candlesticks, but there are some that are very, very effective, and they are more important than the other, which is what we are going to be looking at. So starting from next week, which is going to be our next class, Monday, we are going to start to identify and know the information behind each of these candlesticks. Okay, so we are going to end today's class here. Do you have any questions, sir?
Thank you so much. I really understood what you said.
Okay, no question, right?
Yeah.
Okay, so
But please, I want a request. The previous classes, like when we started the lot size, after the class, there is a video of the class forwarded to me,
yes,
a link.
Yes.
So I went through it. It didn't help me to understand. But the last two classes, there was nothing like that. Maybe you forgot.
You don't receive the classes.
Yes.
Okay. The previous class was not sent to you, right?
Yes.
Hello.
Yes, it was not sent.
Okay. We'll send that to you. Let's keep our mind. We'll send that to you with this one.
Thank you so much.
Alright, you are welcome. So enjoy the rest of the day, Mr. Moses.
Thank you so much. I have a blessed weekend, okay?
Yes, sir. You too.